What's going on, everybody? My name is D. Anthony, and in this video, we're going to be talking about how you can stay and remain profitable even in a bear market. So I know a lot of you guys are coming off that whole wave of 2020 into 2021 where you kind of just buy the dip, buy the dip, buy the dip, everything's going to the moon, and things have suddenly changed. So on this channel, we talk a ton about technical analysis, finding your strategy, understanding your mindset and your psychology, kind of leaving your ego at the door when it comes to trading stocks here. And we go over everything technical. So, from a technical perspective, a technical analysis, a technical trader is not going to worry so much about what news headline is doing this, about what the Fed is doing, about interest rates, about earnings reports coming up. Leave all of that to the longer term investors who are looking to get in on a good or a better deal, and or when they should be holding versus when they should be kind of taking profits. What we do here as a technical day trader is we're able to make money when the stock is going up, but not only going up, going down as well. So if you've been watching or following the markets in 2022, you know that there's been a lot of pain on the streets, and how you can really, kind of make money and become profitable or stay profitable in a bear market is understanding the technicals on when you should be going long and what you should be looking for. So, if you have been stuck in the hamster wheel of always thinking that stocks are going to go higher, or always looking to bounce stocks, you can kind of tell that you've sort of been chopping yourself up. You've been taking some losses. Maybe what was working last year or in 2020 is no longer working. Maybe you started with a small account, ran it up to a very large account, and now it's all the way back down to a small account. So one thing that I kind of want to explain to you is, even though that we're in a bear market, does not mean that we can't make money on both sides. The thing is that we need to understand where we should be going long and when we should be shorting. So what we're looking at here is the triple Qs, which is just a NASDAQ 100 ETF. This is the daily time frame, and I got us backed all the way up to the beginning of the year. You can see that we've had a fairly large leg down, followed by a nice 3-week rally here that was rejected at supply. If you guys don't know what supply is, it's just another fancy word for sellers. It's another fancy word for resistance. Ran into this resistance zone here and put in a second leg down. So just kind of going back the last week and a half, we have come off another bottom here where we're trying to make an attempt at a dead cat bounce. Now, the reason why it's called a dead cat bounce is because anytime you're under macro levels of supply, and these macro levels being the 50-day moving average and the 200-day moving average. So make sure you remember those. 50 and 200, they're very, very important and very, very significant in the technical analysis trading space. When we are under these macro levels of supply, it's very, very hard to kind of spot the bottom. It's very, very hard to try to time the top. It's very, very hard to try to understand, from a bigger, broader perspective. Is the market going higher? Is the market going to go lower? You have to just kind of tell yourself this. If we are underneath the 50-day moving average, the pressure is to the downside. Any bit of rally or green days that we have can be looked at nothing more than just a dead cat bounce. Why? Because we're underneath a macro level of supply. So does that mean that we cannot play long when the stocks are bouncing underneath the supply zone? Now, we can play long, but we just have to understand. It's almost like if you can think back to when you were a kid in kindergarten or preschool, they gave you a coloring book and they said, make sure you stay coloring in between the lines, okay? So as long as we have room in between all of these lines that you're looking at on my chart, which are all moving averages, as long as we have room to the next line ahead, which is your next supply zone, there's room for a trade long. Now, when that stock maybe doesn't reach the final destination and starts to come back and then loses the demand zone, which is your support, if there's room to the next support, then that's the area we want to trade to the downside. I hope you guys are picking up what I'm laying down. So what I'm trying to say here is, if we can just go back, let's say 2 months, okay? When we lost this 50-day moving average for the second time this year, okay? So we were originally trading above it coming into January from December of 2021. We originally lost the 50-day moving average and we went on a very aggressive sell cycle. So if you kind of would have known some technical analysis and let's say you're an options player, you could have said, you know what, let me give myself 2 or 3 months worth of time here on some options contracts. I'm going to buy puts on the triple Qs below the 50-day moving average. Okay, if we reclaim the 50-day moving average, I'm going to exit my puts. Let's say, for example, we buy a 2-month out expiration on those options contracts. We lost the 50-day moving average here on January the 5th. The price was currently trading at around 392. The next time we reclaimed the 50-day moving average, the index was trading at 351. So if we look at when we lost it from 393, 392 to when we reclaimed it, just a matter of 2 months later, that price was $350. You would have made 40 points to the downside only doing one thing, simply shorting the market when we lost the 50-day moving average. When we lost the 50-day moving average, you shorted the market and you exited that position when we closed above the 50-day moving average. That's it. It didn't matter what news headlines came out. It didn't matter about, the market was selling off due to interest rate hikes, or maybe the market's selling off due to the Russia and Ukraine situation, or maybe the market's selling off due to inflation. None of that matters. None of that matters. We could have complete blinders on and only look at the 50-day moving average from a daily time frame and tell ourselves, when this index or particular stock loses its 50-day moving average, I'm going to go short. When a particular stock reclaims its 50-day moving average, I'm going to go long, okay? Or exit my short position. Now, if we would have gotten long here on this reclaim of the 50-day moving average, remember when I just spoke about the 200-day moving average? The 200-day moving average is, let's call it the king, okay? It's the king of technical analysis. The 50 is, let's call him the prince, okay? So if we have losing the prince at the 50-day moving average and the king being the 200-day moving average, so then when we reclaimed this 50-day moving average and now the index started to move higher, we tell ourselves, we are going to take profits into the 200-day moving average. And if we cannot reclaim, which means get over the 200-day moving average, we will exit our position. So when we reclaimed the 50-day moving average at a price of around 352, we ran up to a price of around 371, which is yet again a big win when it comes to trading options, which is 20 points. You want to kind of keep your options contracts right at the money of the current stock price or just a little bit outside. We don't want to go 100 points down the road. We just want to kind of go right where we're kind of currently trading at. And as we ran into this 200-day moving average, we tried to reclaim it, yet the next day was rejected. So when we start to reject the 200-day moving average and then we get another red day, we would start to think about exiting our position. If it's going to take longer than 1 to 2 days to start reclaiming a level of supply, then we just need to exit our position. So not only would you have made 40 points on the downside here, that was very, very seamless, you would have made another 20 points on the upside here. And what did we just speak about the 50-day moving average? If that is the prince, when we lose the 50-day moving average yet once again, we would entirely be looking short bias. And this second time, not only did we lose it, but we gapped down to a price of $344. And within a matter of 2 months, we have hit a loss of $280 on the stock price. So from what was the gap down? 345 down to 280. Guys, this is another 60 points. There's 40 points here. There was 20 points here. There was 60 points here. You would have made a killing in this bear market if you would have just respected and followed this strategy. Now you may be thinking, this sounds a lot easier said than done, and you're absolutely right. Okay, so what kind of gets in between that? Okay, what's going to get in between you perfecting and kind of using this strategy to your advantage is emotions. 100% emotions. You have to understand yourself and you have to understand your psychology as a trader, your comfortability level as a trader. Now, for me, with my personality, I am not the best swing trader. I am very, go, 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 go. Okay. So what that means is for me, I like to actually follow the same kind of strategy, but use it to a day trading advantage. Meaning, if we are below the 50-day moving average, well, instead of putting my money in here, okay, and just sitting through all of this up and down and up and down and up and down and up and down and good news and bad news and good news and bad news and draining my mental equity. Now, mind you, every single trader is different. Some people want they don't want to watch the markets every day. Some people just say, hey, you know what? If we lose a 50-day moving average, that's bearish. I'm going to go short. If we reclaim it, let me know, and I'm going to sell my position. That's completely fine. But the way my inner workings work, and this is where every single trader needs to understand how their inner workings work. My inner workings, I tell myself this. If we are trading below the 50-day moving average, I am 70 to 80% short biased. Meaning that when I enter into the market each and every single day looking for stocks to day trade, I am looking for them to bounce, hit a level of supply, get rejected, and then roll over. And that's when I want to strike, I want to snipe, and I want to day trade stocks to the downside. I want to get in, I want to get green, and I want to get out. For me, that's comfortable. I can sleep at night knowing that my money is not, at the hands of some news headline or some Fed talk or speech or interest rates or any of that, right? So like I said, different strokes for different folks. It's all about what your comfortability level is. Now, in this year, I am profitable in the green, very, very, substantially, for considering what I would consider substantial, right? I mean, I do this full time. I have, a son to provide food for. I have a mortgage payment. I have 2 vehicles that I need to make car payments on, health insurance, auto insurance, utilities, so forth and so forth. So it allows me to be able to come into the market each and every single day, pay the bills, keep the lights on, and continue doing what I'm doing. With that being said, how you make money in a bear market is completely up to you. Now, there's the person who's going to just get short and ride through all the ups and downs, which is completely fine. You would have probably, made just as much or more money, depending on your account size, as a day trader in and out of the market each and every single day with a lot less headaches. But again, it all boils down to your personality traits, okay? With that also being said, just because the market is in a bear market does not necessarily mean that every day is going to be red. For example, in this time period and stretch here, we also had a 3-week rally where I did trade to the long side, and there was technical reasons as to why I was trading on the long side. And some of those technical reasons were this blue line that I'm dragging my mouse across is called a linear regression channel 50. Okay, this is going to act as a support or a resistance level depending on which side of this line we are trading on. So as we came down, cracked this level, reclaimed it once, cracked this level, reclaimed it twice, 3 times, and 4 times, when we finally started to build over this level, I knew that there was a potential opportunity to use these 2 areas as a stop loss, get long here, and ride this trade back to the upside. Okay, now mind you, I didn't just buy on this first green day and magically know when to sell on this green day. I was in and out here. I took a little piece here. I took a little piece here. I came into the market here. So it's like every single day you come into the market with another plan of attack, always looking at it day by day and never what's going to happen in 6 months, what's going to happen in 12 months. Now, there's a lot of other moving pieces to the puzzle, but the big overall picture that I'm trying to paint for you is even though we are in a bear market, you can still be profitable in 2022 day trading and or swing trading stocks. I hope this video helps you guys. All my information is down in the description box if you guys would like to take a look at everything I have to offer. I'll see you guys all on the next video.